Welcome to Capital Allocation Lab Calm. Clear lessons that turn classic investing ideas into practical decisions for long-term owners.
If you value fundamentals over noise, seeking verifiable quality rather than, speculative forecasts, you're definitely in the right place.
Exactly. Please subscribe and like this deep dive to support more free educational content. It really helps us out.
Today, we're embarking on a deep dive into security analysis, specifically tailored for the lay investor. And we're drawing essential guidance directly from Chapter 11 of Benjamin Graham's classic, The Intelligent Investor.
Our mission today feels really crucial. We want to translate Graham's foundational wisdom into truly usable, actionable tools.
That's the goal.
We're aiming to build a systematic checklist, a straightforward two-part appraisal method for valuing businesses, and maybe a quick reference guide for red flags you can spot, right in any annual report.
This really is the critical bridge, isn't it? It moves you past just the mechanical exercise of reading a financial statement
Right.
and into the thoughtful, disciplined process of deciding if a business is genuinely worth your long-term capital commitment.
It's about judgment.
Absolutely. We are focused entirely on judgment and decision quality, stripping away the hype and, frankly, a lot of the unnecessary complexity. Let's unpack this framework.
Graham is just brilliant because he immediately defines the boundaries for the individual investor right at the start.
Okay.
He makes it crystal clear.
Yeah.
Security analysis for you, the individual, is not the complex high-speed modeling that happens on Wall Street.
The kind designed to hit quarterly numbers.
Precisely. That kind of modeling, that chasing of precision, it often breeds a dangerous overconfidence.
So what is it for the lay investor then, according to Graham?
He defines it as the sober, fundamental work of describing a business, carefully reviewing its historical results, importantly, over full economic cycles.
Not just the good years.
Not just the good years, exactly. Right. And then judging its long-term safety and its underlying attractiveness.
Yeah.
It's really about understanding the engine, not trying to predict the next sputter or surge. That makes sense. So where do you start?
It has to begin with simple but quite penetrating questions derived straight from the annual report. You absolutely must be able to articulate, what does this company actually sell? How does it generate cash?
The real basics.
The real basics. And what are the durable economics? What are the enduring competitive advantages or maybe structural factors that protect its earning power through good times and, crucially, bad times?
It sounds fundamental, almost too simple.
It does, but skipping this step is where most mistakes originate. People jump immediately to the stock price or the latest headline.
Yeah. And this leads right into that core mindset shift Graham demands, doesn't it?
Yeah.
What we sometimes call the sleep test.
The sleep test. The purpose of your analysis isn't trying to speculate on the next quarterly earnings beat or, perfectly time a market low. It's something much more profound.
Okay, lay it out.
The real goal is to decide if you would be genuinely comfortable owning this business if someone told you, right now, that no stock quotes would exist for 3 years.
Wow. 3 years, no quotes.
Yeah. If you were locked in purely relying on the underlying fundamentals, the business's actual ability to generate growing cash flows and earnings, would you sleep well at night?
That's a powerful filter. It's a real challenge, almost a behavioral hurdle, isn't it?
It is.
It forces you to completely disconnect from the daily noise, the volatility, and focus purely on the enterprise value itself.
Think about it. A steady utility generating predictable cash flows probably passes that test quite easily.
Right.
But a highly speculative growth stock, one that needs constant access to fresh equity capital just to survive, it simply cannot pass that test. The sleep test is a fantastic filter against hype.
And that inherent skepticism, it extends to the methods we use too, right? Graham warns against something he calls pseudo-precision.
He does, a very strong warning. This is the use of, let's say, advanced mathematics or really intricate financial models that, they look impressive on paper.
Yeah, they look scientific.
They look scientific, but often they just disguise high-level speculation as quantitative science.
It's psychological, isn't it? We feel more in control with complex tools.
Absolutely. But if the tools are overly complex, if they're not easily repeatable, and especially if they rely heavily on assumptions about the distant future that are inherently unknowable,
then they become misleading.
Exactly. They become misleading, dangerous even. Graham insists, quite rightly, that our analytical tools must be simple, they must be robust, and crucially, verifiable by looking backward at history, not purely predictive guesswork.
Okay, so if we're avoiding that pseudo-precision, It seems like we need to adopt, well, extreme humility when we think about the future.
That's the perfect word, humility.
We see Wall Street analysts constantly tweaking their models for the next quarter, maybe the next year. But for an individual investor trying to project 5, 7, even 10 years out, those models can become incredibly unstable, right?
Dangerously unstable. It's because of what's called the compounding error. Think about it. A small initial error in your forecast. Maybe you overestimate market share growth by just 1% in year one.
Seems tiny.
It seems tiny, but that error multiplies over long horizons. By year 7 or 10, that tiny initial mistake can snowball into a massive, completely misleading surprise in your valuation.
So the further out you forecast, the less reliable it becomes.
Exponentially less reliable. This inherent instability is exactly why we must favor simple arithmetic approaches based on history over these ornate, multivariable forecasts that are often just based on hope.
So what's the alternative if we can't precisely predict the future?
The alternative is what we call the roughly right approach.
Right.
We have to acknowledge upfront. We cannot be exactly right about the future stock price next week or next year.
Okay.
Our objective is much more modest and, importantly, much more defensible. It's to be roughly right about the business's long-term enduring value.
And how do we get roughly right?
We rely heavily on observable data, things that are already concrete and verifiable, like the company's documented performance over a full economic cycle.
Again, the full cycle emphasis.
Absolutely. It's verified financial strength and ideally a conservative capital structure, the consistency or maybe the restraint of its dividend policy, and just the plain English logical story of the business model itself. This data anchors us firmly in reality.
That heavy reliance on historical observable data. That's what allows us to define a range of outcomes, isn't it? Instead of falling into that trap of a single, falsely precise point estimate of value.
Precisely. Every business has variables, uncertainties. Therefore, its value should always be expressed conservatively as a range, maybe from a pessimistic but still plausible low end up to an optimistic but still reasonable high end.
But establishing that range isn't the end game, is it?
Not at all. The entire analytical exercise is frankly worthless if, after establishing that conservative range, we don't then insist on a substantial margin of safety before we actually commit capital.
Define margin of safety in this context.
It means if the current market price is anywhere near your conservative estimate of value, even the high end of your range, your analysis demands that you walk away. You need a significant discount.
So humility forces you to acknowledge the risk. And the margin of safety is how you get compensated for accepting that unavoidable risk.
That's it, exactly. It's your protection against being wrong, which, given the future is unknowable, you sometimes will be. You know, before diving deep into common stocks, Graham always reinforces this core lesson that we learned from bond investing.
Which is?
That safety lives in earning power, not in market hype, not in the latest quarterly trend, not in a fancy story. It's the earnings. You have to internalize this philosophy even when you're buying equity, not debt.
That's a really helpful frame. Applying the protective mindset of a lender, even when you're an owner. So what are those classic safety checks a bond investor uses that we, as potential stock owners, should really adopt?
They're all about survivability, especially through a downturn. First and foremost, earnings coverage. Meaning the company's ability to cover its interest payments with its earnings. But crucially, and this is where people slip up, you cannot use the company's peak earnings year for this calculation.
Oh, got to use the average again.
You need to look at multi-year averages, specifically including periods of recession or just reduced demand. Can the average earning power, the normalized earning power, comfortably service all the debt? If the answer is no, or maybe just barely, then the structure is too brittle.
Okay, and that analysis of earnings coverage, it directly informs the quality of the capital structure, right?
Directly. We have to actively avoid companies with top-heavy debt configurations. We need to see a verifiable, sensible structure, and that requires diligent work sometimes to uncover hidden liabilities.
Like what kind of hidden liabilities?
Well, the big one is often significant off-balance sheet lease obligations. You have to dig through the footnotes sometimes. These function exactly like debt. They're fixed commitments, but they're sometimes treated less seriously by analysts or even management.
So true financial strength has to account for all fixed obligations, not just the ones labeled debt.
Absolutely. Then we also look for adequate size and diversification of revenues.
Why is size important for safety?
Generally, smaller, highly concentrated businesses, maybe they're concentrated geographically or worse, dependent on a single major customer, they are just significantly more vulnerable to shocks than their larger, more diversified counterparts. It's about resilience.
Makes sense. And what about assets? Does the value of the stuff on the balance sheet matter?
It depends. Tangible asset values matter tremendously for certain capital-intensive industries, think regulated utilities, real estate investment trusts, maybe some investment companies.
Okay.
But for most modern service businesses or technology firms or consumer brands, it's the recurring earnings that drive safety, not the potential liquidation value of the desks and computers on the balance sheet.
So a strong asset base is nice, but enduring earning power is what really pays the bills and ensures survival.
That's the key takeaway. So the spirit of the bond investor applying it to stocks really boils down to this. Don't buy what the balance sheet cannot soundly support. Strength must always, always precede the exciting growth story. If that foundation is weak, the roof, no matter how promising it looks, is eventually going to collapse.
Okay, this feels like we're moving from the why to the how. We're transitioning from the philosophy to the practical engine of valuation. Graham's two-part common stock appraisal method.
That's right. And this framework is really powerful because it forces you to start with verifiable reality first. Only then does it allow for modest, reasoned adjustments based on likely future changes.
So what are the two parts?
The appraisal splits the analysis very cleanly, very logically. Part one is the past performance value, or PPV. This answers, what is the business verifiably worth if it simply maintains its historical normalized earning power? This is your solid anchor.
Okay, anchored in the past. And part two.
Part two involves the forward modifiers. These are small, and I stress small sensible adjustments, either up or down, based only on concrete observable changes that have a very high probability of actually affecting future cash flows. No wild guesses.
Okay, this already sounds much more robust, much more grounded than starting with, say, a complex DCF model built on layers of optimistic, hard-to-verify assumptions way out in the future.
It's designed to be. It keeps you tethered to reality.
All right, let's dig into 4A then. Calculating that past performance value, the PPV anchor, hashtag 4A, past performance value, PPV calculation.
Right. To establish the PPV, the first step is data assembly. You absolutely must assemble a comprehensive 7 to 10-year view of the company's results.
Not just the last year or two.
Definitely not. You cannot rely on the most recent, often inflated peak year results. You need the full economic cycle in your data.
Okay, what specific data points do we need for that 7-10-year window?
You need the basics, of course. Revenue, operating margin, net income, and shares outstanding for every single year in that period.
Got it.
But, as we've hinted, net income isn't always the full story. Cash flow is often the ultimate truth, so we need to go a bit deeper.
How so?
We need to try and estimate the owner's cash earnings. This is basically the cash the owner could theoretically pull out of the business each year without damaging its underlying operations or future prospects.
And how do we calculate that practically?
The practical calculation is usually start with net income, add back the non-cash charges like depreciation and amortization. And remember, those are accounting entries, not actual cash outflows.
Okay.
And then, this is important, subtract the cash absolutely required just for maintenance capex.
Hold on. Explain that. Why only maintenance capital expenditure? Why not subtract the total capex figure reported?
Great question. Because the total capex figure reported by the company usually includes growth spending, money spent on building new factories, buying new machines for extra capacity, or maybe R&D for totally new markets.
So that's investing for the future, not maintaining the present.
Exactly. As an investor trying to value the existing business based on its past performance, we only want to subtract the bare minimum cash needed just to keep the current machine running at its current level, that maintenance capex figure.
Okay, so net income plus non-cash charges minus maintenance capex gives us a clearer picture of true recurring cash generation.
A much clearer picture. We should also track standard free cash flow, FCF, which often uses total capex and dividends per share just as a cross-check and for context.
All right, so we have, say, 10 years of this normalized cash earnings data. What's the next absolutely essential step?
Normalization. This is critical. We compute the median or perhaps a trimmed average of these earnings, EPS, and free cash flow, FCF, per share figures over our 7-10-year period.
Why the median or trimmed average? Why not just a simple average, the mean? especially you mentioned for cyclical businesses.
Because a simple arithmetic mean, the average, can be grossly distorted by outliers, either extremely good years or extremely bad years.
Give me an example.
Imagine a manufacturer that has 9 decent profitable years, but then one massive loss year during a major recession. The simple average, the mean, will be pulled way down by that one bad year, and it might not represent the company's true underlying earning power through a normal cycle.
And the opposite could happen too. A huge one-off profit could inflate the average.
Precisely. So, using the median, which is just the middle value when you line them all up, or a trimmed average, which literally throws out the highest and lowest results before averaging.
That gives us the most representative and enduring earning power, right? It removes the noise from extraordinary one-off events.
Exactly. That normalized figure is the verifiable history we need to rely on for our PPV.
While we're looking at that historical data, are there other quality checks we should be doing?
Definitely. While you're normalizing, you should be asking, how stable were these earnings historically? Did the company suffer multiple loss years or just one? How deep were the losses? Review the share count trend. Is it creeping up year after year because of excessive stock compensation? That's dilution. Or is it steadily falling due to disciplined share buybacks? That's good.
And the dividend.
Check the dividend record. Is it reliable, uninterrupted? And importantly, is the payout ratio conservative, meaning they aren't paying out more cash than they sustainably generate?
Okay, makes sense. So now we have our normalized, reliable, historical EPS or FCF per share figure.
Yep.
What's next?
Now comes the crucial step of assigning a conservative multiple to that past earning power. This is where discipline is absolutely paramount. No heroic assumptions here.
What kind of multiple are we talking about?
For a durable, average quality firm, one that's stable, resilient, maybe not a hyper-growth superstar, but a solid business, we should really anchor our thinking around 10 to 15 times that normalized earnings figure.
10 to 15 times normalized EPS. What if it's more cyclical?
If the business operates in a highly cyclical industry, or it's very capital intensive, or maybe its margins jump around a lot, then a multiple in the single digits might be much wiser. You have to be more conservative.
And if we're using the cash flow metrics instead of EPS?
If you're using the more conservative cash metrics, like that owner's cash earnings or even standard FCF, you'd typically apply a slightly lower multiplier, maybe something like 8 to 12 times the normalized free cash flow figure.
Okay, so applying that conservative multiple to our normalized historical earnings or FCF
That gives you the fundamental PPV range, the past performance value range. This serves as the concrete, historically grounded anchor for your entire valuation analysis. Hashtag 4B, forward modifiers, qualitative and concrete.
All right, anchor set. Now for the second part, which you flagged as potentially the most dangerous step, the forward modifier.
It can be dangerous, yes, because this is where optimism can creep in unchecked.
So we need a strict rule of thumb here, right?
Absolutely. The rule must be, apply small adjustments only when the evidence for change is concrete and nearly certain. This is precisely where investors tend to rationalize overpaying for stocks based on fuzzy future hopes. We have to resist that temptation to project a massive, uncertain growth or improvement.
Okay, so we're looking for tangible structural changes, not just, optimistic marketing slogans from the CEO. What would justify a modest plus adjustment?
You could justify a small positive nudge if, for example, the capital structure is demonstrably, measurably improving. Perhaps leverage, like net debt to EBITDA, is clearly decreasing year after year. Or maybe the interest burden has eased significantly because they refinance debt on much better terms. That's concrete.
What about the business itself?
A plus adjustment might also be warranted if the core business quality is visibly strengthening. For instance, maybe the company has successfully invested in its ecosystem, and you see evidence that switching costs for its customers are genuinely increasing. That adds durability.
Or maybe customer concentration is falling.
Exactly. If a key risk like high customer concentration is clearly falling over several years, that mitigates risk and deserves a small positive nod.
And capital allocation.
Yes, we should reward sensible capital allocation with a modest plus. Things like disciplined reinvestment back into high-return projects within the business. Or, critically, consistent share buybacks that are demonstrably performed well below your estimate of intrinsic value. Those actions directly increase the remaining shareholders' ownership percentage.
Makes sense. Now, what about the other side? When do we apply modest minus adjustments?
We have to be just as diligent here, applying small negative modifiers for verifiable negative trends. A classic example. If management seems to be constantly engaging in empire-building acquisitions, especially ones that rely on issuing lots of new stock, that's often a warning sign and deserves a minus.
What about accounting?
If the accounting clarity seems to be eroding, if the company increasingly relies on frequent adjusted earnings figures or other miracles to mask true costs or underlying volatility, that lack of transparency warrants a clear minus adjustment.
Okay. What if the industry itself is getting tougher?
That's a big one. If the underlying industry economics are clearly deteriorating, maybe price taker risk is rising because competitors are flooding the market with supply, or the industry's overall pricing discipline is just eroding into a price war, you absolutely must factor in a negative modification, regardless of what optimistic projections the CEO might be making in the annual letter.
And we have to circle back to growth, don't we? Graham's famous skepticism about growth assumptions.
We absolutely must. High growth, especially sustained high growth, is arguably the single least knowable, least predictable input in any long-term valuation calculation.
So the bottom line is,
The bottom line is this. If your investment thesis only works, only justifies the current price because you have baked in aggressive, high double-digit growth assumptions for the next 5 or 10 years, it's probably speculation, not sound investment based on Graham's principles.
so growth should be seen as.
Growth should be treated as a potential bonus, a pleasant upside surprise, not a fundamental requirement for the investment case to be sound based on its historical valuation and modest concrete modifiers. So let's say we've calculated our PPV anchor range and we've applied our very modest concrete forward modifiers. We now have a rational conservative estimate of the business's intrinsic value range.
Okay.
But this still leaves a question hanging, doesn't it? Why should two different businesses, even if they have similar normalized earnings per share, receive different valuation multiples?
Right. Why might one deserve 15x earnings and another only 10x?
Graham outlined several rational drivers that can justify a difference in valuation multiples between companies, completely independent of just market fads or sentiment.
We touch on long-term prospects, but you keep saying, judge those with profound humility.
Extreme humility, yes. But more concretely, verifiable financial strength and liquidity are critical differentiating factors. A company sitting on a fortress balance sheet, maybe with excess cash, that allows it to be opportunistic during a recession. That company naturally deserves a premium safety multiple compared to a heavily debt-laden competitor, even if earnings are similar today.
That makes sense. What else?
The third factor is the capital structure itself. We know leverage is a massive amplifier.
It's a double-edged sword.
Exactly. It boosts returns spectacularly when things go right, but it dramatically multiplies the pain, potentially fatally, when the economic cycle inevitably turns down. So a company that uses minimal, sensible leverage consistently deserves a higher safety multiple.
Okay. Prospects, financial strength, capital structure. What's number 4?
Fourth is the dividend record. And this is a really powerful, tangible, verifiable quality signal.
Why is the history so important?
An uninterrupted history of paying dividends, particularly one that spans multiple recessions, maybe financial crises, that speaks volumes about management discipline, about the durability of the underlying business, and about the true stickiness of its customer relationships. It's verifiable strength in action.
And number 5.
And finally, the current dividend policy needs to be sensible and conservative. It has to be perfectly aligned with the business's genuine, demonstrable need for reinvestment back into itself.
What's an example of a bad policy then?
Well, a business that's, say, pouring 90% of its earnings out as dividends, but you can clearly see from the financials that it desperately needs that cash for essential maintenance or critical reinvestment just to stay competitive. That policy is signaling future instability, not strength.
Okay, so the big takeaway here seems to be that a fair, rational, multiple rewards strength you can actually verify with historical data, not just stories you're being told in a presentation.
That's precisely it. A company with a solid 20-year history of increasing its dividend year in and year out provides far more tangible conviction about future value and resilience than, say, a glossy 20-page slide deck outlining some unproven disruption strategy. Verifiable past over projected future.
And this focus on verifiable strength, it leads us perfectly into the practical filter that every lay investor needs, doesn't it? The Sleep Well 10 checklist.
Exactly. Think of this as the mandatory filter you apply the moment you first crack open an annual report or start looking serially at a company. If a business fails several of these fundamental checks right at the start, you should probably stop the analysis immediately and move on.
It saves you time and prevents you from falling for a good story masking bad fundamentals.
Yeah.
Let's run through all 10 points. The idea is if you can't answer these affirmatively, the analysis stops, right?
That's the discipline. Okay, number 1, understandable model. Can you explain in simple terms how the business makes money? Does it have one or two core, simple ways it creates value? If you need like a PhD or complex flowchart just to explain where the revenue comes from, it's probably too complicated to own safely.
Fair enough. Number 2.
2, earnings quality. Is cash conversion steady over time? Meaning, does cash from operations generally track reported net income? Are there very few adjusted add-backs that seem to constantly hide true costs or smooth out volatility? You want the cash flow statement to reliably back up the income statement over multi-year periods.
3. Balance sheet strength. Is the net debt clearly manageable? And not just manageable today at the peak of the cycle, but could it handle a full, painful economic downturn without putting the company at risk?
4, dividend habit. Is there a long, preferably uninterrupted dividend record? Or if it doesn't pay a dividend, is there at least a documented capital allocation policy that is clearly conservative and matches the company's long-term economics and genuine reinvestment needs?
5. Shareholder alignment. What's the share count doing over time? Is dilution minimal? Or are they constantly issuing stock? And if they're doing buybacks, are they executed thoughtfully, ideally below your estimate of intrinsic value? Or are they just, window dressing to offset excessive stock options granted to management?
6, returns on capital, ROIC. This is crucial. Is the company's return on invested capital consistently and demonstrably above its cost of capital throughout various economic cycles? If a company habitually invests capital at returns below its cost, it is actively destroying value no matter what the stock price does short term.
7. Competitor reality. What's the industry like? Is it brutally tough, a pure commodity race to the bottom where only the absolute lowest cost producer survives? Or does the company have some kind of barrier to entry, some differentiation, some pricing power that protects it somewhat? You need some defensible moat, however small.
8, customer mix. Is the business reasonably insulated by having a diversified customer base? Or does a single client dominate, say, more than 10 or 15% of total sales? That's a risk. And, related, is pricing power evident? Can they actually pass on modest cost increases to customers without losing them?
9. Capital allocation track record. When they make acquisitions, are they disciplined, relatively rare, and demonstrably value accretive over time? Are goodwill write-offs infrequent, meaning they didn't overpay? Does management's stated strategy consistently repeat the successful patterns that generated value in the past, or are they constantly chasing new fads?
And finally, the payoff, number 10, price versus PPV. After all this analysis, does the current market price sit demonstrably below your conservative, calm PPV midpoint that you calculated earlier? This check ensures you actually have the necessary margin of safety built into your decision before you even think about buying.
Wow, that's a comprehensive list. And the discipline is key. You said if 4 or 5 items fail?
If 4 or 5 of these fundamental checks raise red flags, the analysis should just stop right there. You don't need to waste another minute building a fancy spreadsheet model. You need to find a different, higher quality business to analyze. Honestly, the most potent tool the lay investor possesses is often the courage and the discipline to simply say no and move on. Okay, theory is great, but let's immediately try to apply this whole process with a quick mini case study. Let's imagine a hypothetical company. We'll call it Acme Fasteners.
Okay, Acme Fasteners. What kind of company is it?
Let's say it's a mid-cap, pretty durable industrial business. It specializes in making critical, high-spec fasteners used in heavy equipment manufacturing, things like tractors, construction gear. So it's a cyclical industry, but supplying essential components.
Got it. And we've done the homework. We've assembled the 10 years of financial data and calculated our normalized figures using trimmed averages.
Exactly. Let's assume we did that work. Revenue has grown modestly over the decade. The operating margin averaged a pretty steady 12%, and our normalized trimmed average EPS median came out to $3.70 per share.
Okay, $3.70 normalized EPS. What about the balance sheet and dividends? Did it pass those sleep well checks?
Let's say it did. The balance sheet looks robust. Net debt is low, maybe only 1.2 times EBITDA. Interest coverage is exceptionally strong at 8 times earnings before interest and taxes. And crucially, the dividend has been paid every single year for 22 years, straight through the last recession, with a conservative payout ratio averaging around 45% of earnings.
22 years uninterrupted. That's a good sign. What about capital allocation share count?
Also looks disciplined. Let's say the share count has actually fallen by 8% over the past decade due to steady buybacks. And the economics look decent too. The return on invested capital, ROIC, consistently average 11 to 12%, which is comfortably above our estimated 8% cost of capital for this kind of business.
Okay, so based on that, Acme Fasteners clearly passes the initial Sleep Well 10 checklist with flying colors.
Agreed. So now, time for the PPV calculation. Let's be conservative. We'll use a multiple of 10 times for its normalized free cash flow, FCF, which, let's assume for simplicity, we also estimate is around $3.70 per share after accounting for maintenance CapEx.
Okay, 10 times $3.70 FCF gives us.
Gives us a baseline value of $37 per share based on cash flow. Now let's use the normalized EPS figure of $3.70. Since earnings quality looks good and the business is durable, maybe we use a slightly higher but still conservative multiple of 12 times for EPS.
Okay, 12 times $3.70 EPS is $44.40.
Right, $44.40. So our historical past performance value, PPV range, is roughly $37 to $44.40. The midpoint of that range is around, call it $40.70.
Okay, $40.70 is our anchor based purely on past normalized performance. Now for the forward modifiers. Are there any concrete reasons to adjust this up or down slightly?
Let's say we found a couple. We could justify a modest plus adjustment because we read in the annual report that management has explicitly stated a target to get net debt under 1 times EBITDA within 2 years, further strengthening the balance sheet. That's concrete. And maybe we also see some evidence that due to increasing standardization of parts in the heavy equipment industry, Acme's fasteners are creating slightly higher switching costs for their big industrial customers. Another small plus.
Okay, any minuses to offset those?
Yes, we absolutely have to apply a small minus adjustment simply because its core end markets, construction, agriculture equipment, are inherently cyclical. We always want to be prepared for the next downturn, even if things look good now.
So we have a couple small pluses, one small minus. What's the net effect on our $40.70 midpoint?
Net effect, let's say we bump that midpoint up just modestly, maybe from $40.70 to a firm $42 per share. This $42 represents our best conservative estimate of Acme's intrinsic value today, based on history plus concrete adjustments.
All right, $42 is our number. Here comes the moment of truth then, the real test of discipline. What if we look up the stock quote today and Acme Fasteners is trading in the market at $55 per share?
Then the disciplined, intelligent investor following this process must absolutely, without hesitation, move on. $55 is a 31% premium to our carefully derived $42 conservative estimate. There's no margin of safety there. In fact, it looks significantly overpriced relative to its fundamentals.
So the willingness to just walk away, even from a good company, when the math fails to offer that margin of safety, that's the real edge, isn't it?
That is the defining edge. Discipline trumps desire every time in this game. Hashtag tag 6B. Red flags you can hear before you see.
Okay, that case study makes the process very clear. Before we wrap up the tools section, let's quickly cover those red flags you can often hear in management commentary before the serious damage fully shows up in the reported financial statements.
Yes, these are phrases often found in filings, press releases, or earnings call transcripts that should immediately trigger your skepticism and send you digging straight into the cash flow statement for verification.
What's the number one siren we should listen for?
For me, it's the perennial optimistic use of adjusted EBITDA excluding non-recurring expenses, especially when you see it repeated quarter after quarter after quarter.
Why is that such a red flag?
Because if management is constantly stripping out certain costs and calling them non-recurring, but they keep recurring, well then by definition, they are recurring costs of doing business. You must always start by believing the GAAP earnings first before considering any adjustments.
Okay, constant adjusted earnings is suspect. What else?
Another classic is the big announcement of a transformational acquisition. Be very wary of that phrase. Often, when you actually dig into the financials later, you find it leads invariably to rapidly growing goodwill on the balance sheet, meaning they likely overpaid.
But stagnant or even falling cash flow from operations.
Exactly. Transformational frequently turns out to mean expensive, overly complex, and potentially value-destroying for the existing shareholders.
Got it. What about customer concentration?
Listen very closely when executives say something like, customer concentration is improving. But then you look at the details and find that the single top customer still accounts for a staggering 25% or even more of total sales.
So the improvement is marginal, but the risk is still huge.
Precisely. That concentration remains a massive risk factor. It gives that key customer enormous potential leverage in price negotiations down the line. Don't let management smooth talk you out of recognizing that risk.
Okay, what else should make our ears perk up?
Be deeply wary of the phrase increased flexibility to invest, especially, and this is key, when that statement is paired with two other verifiable facts you can find in the financials: a consistently rising share count, dilution, and simultaneously falling returns on invested capital, ROIC.
So they're issuing more shares, getting worse returns on their investments, but calling it flexibility.
Exactly. That isn't flexibility. That's often just dilution and value-destroying empire building disguised with positive-sounding strategic language.
And one more, maybe related to cash flow.
Yes, look out for management trying to excuse poor operating results by claiming seasonally strong cash generation is just around the corner, when the actual cash flow from operations has consistently trailed reported net earnings over several multi-year windows.
So the cash just isn't matching the reported profits over time.
Right. If the language gets more flowery and creative while the actual cash generation gets tighter and lags reported earnings, you absolutely must believe the cash flow statements, not the optimistic press releases. Cash is fact. Earnings can sometimes be opinion.
Okay, we've covered the analysis of individual companies in depth. How does this fit into building an actual portfolio? What did Graham say about that?
Well, moving to portfolio strategy, Graham was a strong champion of sensible diversification, especially for typical individual investors.
Why specifically for individuals?
His reasoning was simple and humble. Because most of us are not super forecasters, we simply aren't. And therefore, we will make mistakes in our analysis or valuation from time to time. It's inevitable.
So diversification is mistake management.
In large part, yes. Holding a sensible number of independent, uncorrelated positions ensures that those inevitable mistakes remain survivable. It prevents the entire portfolio plan from being wiped out by a single bad bet or unforeseen event hitting one company. And, on the flip side, it allows your genuine winners the time and space to compound significantly without being overly diluted by one disaster.
So the goal isn't necessarily to own hundreds of stocks like an index fund.
No, not necessarily. The objective is more to own enough genuinely good decisions, say maybe 10 to 20 well-researched, high-conviction names for a serious individual investor so that one or two errors along the way won't sink the entire ship.
It seems like long-term success then boils down to a few key things.
I think it does. You could call it the compounder's triangle. First, the quality of your analysis based on the principles we've discussed. Second, iron discipline on the price you pay, always demanding that margin of safety. And third, unwavering patience in your holding period, letting the business's compound value over time. Get those three right, consistently, and you stack the odds heavily in your favor. Hashtag 7B. Calm answers to common questions.
All right, let's try to quickly address some of the most common questions people have when they first encounter this Graham-style approach. Maybe a quick back and forth.
Sounds good. Fire away.
Q. Okay, first one. Do I really need a complex discounted cash flow DCF model with terminal values and all that?
Honestly, for most lay investors, absolutely not. The PTV method we outline, past performance value plus concrete forward modifiers, combined with demanding a generous margin of safety, that framework keeps you out of the vast majority of potential investment trouble without forcing you to invent impossible levels of precision about the distant, unknowable future like terminal values require. Keep it simple and anchored.
Q. Makes sense. Next. What multiple should I actually use when I'm calculating that PPV for a reasonably durable business? Is there a magic number?
No magic number, but a reasonable starting point comes from the business quality itself. As we said, for durable, average quality firms, anchor your thinking between 10 to 15 times normalized earnings. If it's a more cyclical or lower quality business, it deserves significantly less, maybe single digits. The key is, if you find yourself having to stretch the multiple way beyond 15x just to make the current stock price look reasonable, don't do it. Walk away.
Q. Okay, crucial one. How do I handle or incorporate future growth into my valuation calculation?
That is critical. Treat potential future growth primarily as a bonus, never as a core requirement for the investment thesis to work today. If your calculation only justifies the current price because you've plugged in bold, high double-digit growth assumptions for years, out assumptions that are not yet verifiable, you've crossed the line from investing into speculating. Buy the existing quality and verifiable earnings power. Let the future growth be a pleasant upside surprise if it happens.
Q. All right, and the flip side. When is the right time to actually sell a stock using this approach? It sounds like you hold forever.
Not necessarily forever, but the holding period should be long. You sell primarily for three reasons. One, When your original investment thesis fundamentally breaks, maybe the industry economics permanently change for the worse, or management starts making demonstrably poor capital allocation decisions. 2, you sell when the market price rises to far exceed your updated conservative appraisal of intrinsic value, meaning your margin of safety has completely evaporated and the risk-reward is no longer attractive. Or 3, you find a demonstrably better opportunity elsewhere that offers a much larger margin of safety. Otherwise, if the business remains good and the price reasonable, sit still and let compounding do its work.
Q, last one. How many different stocks, how many positions should a serious individual investor typically hold? Is there an ideal number?
A. Again, no single magic number, but the guiding principle is enough to sleep well at night. For most serious individual investors applying this kind of analysis, that usually translates to somewhere between 10 to 20 names, ideally spread across different economic drivers or industries to achieve reasonable diversification. Much less than 10, and single stock risk becomes very high, much more than 20 or 30, and it becomes very difficult to follow each business properly. Hashtag 7C, the reusable owner's dashboard.
So we've got the philosophy, the calculation method, the checklist, the portfolio context. How do we pull this all together into a practical, repeatable process for each company we analyze?
To really solidify this theory into actionable, consistent practice, I strongly recommend creating what you could call a reusable owner's dashboard. Think of it as a mandatory one-page summary for every single company you seriously research or own.
A one-pager. Why is that format helpful?
Because it forces simplification and discipline. It prevents key assumptions or risks from getting lost in pages of notes or complex spreadsheets. It keeps the core thesis front and center.
Okay, what absolutely needs to be on this one-page dashboard?
It needs the essentials. First, what the business does, in one simple sentence, the elevator pitch. Second, why it lasts. 2 or 3 real, defensible, competitive advantages its mode. Third, your calculated normalized EPS and/or FCF and the resulting PPV range you determined.
Got it. Business, moat, valuation anchor. What else?
You also need your 3 key strengths and, just as importantly, your 3 key risks clearly bulleted out. Then, try to document the verifiable habits of management regarding capital allocation, not just their promises from the annual report.
Okay, strengths, risks, management habits.
And then, critically, you must force yourself to define what specific events or data points would change your mind about this investment. Think of it as the pre-mortem risks. Write them down in advance.
Oh, yeah.
And finally, state clearly the exact margin of safety, for example, 30% discount to your midpoint value, you require before you would actually consider buying.
That dashboard sounds like a lot of work up front, but incredibly valuable for decision-making and ongoing monitoring.
It is. Honestly, the consistent, disciplined habit of actually filling out this simple dashboard for every potential investment, that is the only truly sustainable analytical edge you need in the markets over the long run. It's process over prediction. Hashtag TAG70. Closing takeaways.
This has been incredibly insightful. Let's try to synthesize the absolute core lessons from today's deep dive into Graham's approach for the lay investor. What are the main takeaways?
I think it boils down to 4 fundamental pillars. First, always start with past performance that you can actually verify over a full economic cycle. Anchor yourself in reality.
Just a second.
Second, modify that historical baseline carefully and only for future changes that you can convincingly defend with concrete, observable evidence. Be incredibly skeptical of rosy forecasts.
Third pillar.
Third, always demand a generous margin of safety, a significant discount between the market price and your conservative estimate of value before you commit any capital. This is your protection. And fourth, diversify your holdings sensibly across enough independent opportunities to ensure you can survive being human, because you will make mistakes occasionally.
Start with the past, modify carefully, demand safety, diversify. It's a powerful framework. Any final thought you want to leave our listeners with?
Just this. Make a conscious effort to stop analyzing stock tickers and start truly analyzing businesses as if you were going to own them privately for years. Remember that numbers are just a language. Learn to read that language simply, focusing on cash flow and balance sheet strength, and you will begin to clearly hear what real risk and verifiable resilience actually sound like.
This is Capital Allocation Lab. Our mission is to teach disciplined, long-term investing by revisiting classic ideas and applying them to today's crucial allocation decisions.
Thanks for joining us for this deep dive.
If you found this useful, please like the episode and subscribe. It really helps us keep these lessons free and allows us to reach more long-term owners like you.
And please, leave a comment with your questions. And maybe tell us which fundamental investing concept you'd like us to unpack next time. Thanks again for listening.